So we have a great panel session today. I'm Chris Matta. For those of you that don't know, I'm the president of 3IQ US, and I'm being joined today by Mark Connors, who is our head of research, and Alex McDougall, who is the president and CEO of Stablecorp. We have a panel discussion focused on talking through the volatility in the crypto asset market and the broader macro market more generally. So the conversation will be about 30 to 35 minutes, and then we'll leave the remaining time for open Q&A. So as the conversation goes on, please feel free to drop any questions in the chat. We can answer real time, and we'll also save time for the end to go through all the questions and have an open conversation. So with that, enjoy the panel discussion and see you in a few minutes. Hi, everyone. Thank you for joining the 3IQ webinar today, where we're going to focus on the volatility within the crypto asset market and how the broader macroeconomic environment is impacting the crypto ecosystem. I am Chris Matta, the president of 3IQ Digital Assets US, and I'm joined today by Alex McDougall, who is the president and CEO of Stablecorp, and Mark Connors, who is the head of research here at 3IQ. And what we're going to do today is we're going to cover, first and foremost, the broader macroeconomic environment. Crypto obviously has not been immune to the broader risk-off environment currently, and Mark is going to really dive into some detail there. And then secondly, we're going to have Alex talk through the collapse of some of the recent crypto protocols, some of the stress that's being put on the system across the digital lending space, and how Celsius specifically is potentially impacting the space more broadly. And then finally, we're going to tie that all together to look forward over the next 6 to 12 months and talk through how the broader macroeconomic environment is going to impact crypto assets and how crypto assets kind of fit into that broader picture and how investors can potentially think about allocating to this asset class. So with that, Mark, we'll start with you on the macro environment. And if you could just give us a general overview of what that landscape has looked like. Obviously, we're in a bit of an unprecedented period at the moment with very low interest rates, high inflation, high debt to GDP. Can you talk us through how that has impacted the broader, risk assets in general?
Yeah, sure. So as you said, we're in a very unique macro period in terms of level of debt, which was the remedy by policymakers globally in response to COVID. It pushed debt to GDP in the US north of 130%, which was World War II type levels, and they pushed rates down to zero. Now, today we're seeing some of that blowback in terms of inflation as the increased money supply, 18% back-to-back years of monetary growth. It went into hard assets, Chris, and it didn't necessarily go into investment in the economy. So you saw a divergence. Now, why anyone should care about that is because the monetary policy did not feed the real economic engine of GDP, which declined, and as we know, printed a negative quarter, but also did for investors, it also skews risk metrics. When you have profligate policymakers in central banks, you don't really know what risk is because they are providing liquidity and there aren't any defaults. So no one's really held to task. And what you're seeing today is, for only the third time in 20 years, are you seeing the Fed change the supply of cash they supply the market. Since 2002, they've been a net provider of supply from $800 billion in 2002 or $600 billion up to its $8.9 trillion today. In the last 2 weeks, they've taken some of that down. We've only seen that in 2007, right before the 2008 crisis, and 2019, when the repo market failed, when they tried to push that money back onto the banks, and the banks declined to be the lender, and the repo market failed. So we are in unprecedented times as far as absorbing not 600 billion or 2.3 trillion like after the '08 crisis, but $8 trillion. So that's one reason why I think the blowback in hand over to Alex about why crypto has been front and center here, because crypto set up these lending platforms to track yield during an environment where risk premiums were not tested. Only in the last 2 weeks have they been tested. So that's how I would gauge the environment. Tough time for the Fed to unwind, and crypto, given their increased financing platforms between the '08 crisis and today, they're the ones that are feeling the pinch as opposed to the banks.
And so when we look back, you mentioned World War II, Mark. Are there other historical time periods that we can look to think through how this may play out in the future? I know you and I have talked about the 40s as another analogy that a lot of people have drawn parallels to. You know, are there other data points during those historical periods that can be validating to think about how we move forward from here?
Yeah, so Bretton Woods, wonderful period. Demographics were tailwind. You had global devastation to the downside, but you had all upside in the terms of a global rebuild. So economic activity and debt-driven spending made sense. So we're able to earn our way out of that debt load at 140. That was in 1944 to 47. Today, with entitlements, it's a very different launching point. So same debt load, more headwinds. Now let's move to 1971, when we got off that Bretton Woods gold standard. Again, there was a wartime-like financing. This time Vietnam, and US went into deficit spending for the third time in 3 years. People started to come in to ask for their gold back. In New York Harbor, Nixon broke it in August of '71, and gold went from $42 to $500 over the rest of the decade, up 10 times. So that's probably the most analogous, we believe, to what could happen to a finite, less inflationary hard asset like gold. And Bitcoin could be that analogy during this time, given, again, wartime-like financing. We have profligate spending, and instead of maybe gold, Bitcoin, we think, given the digital-based ecosystem that's born out of the last 20 years, might be the asset that gains traction in the community as a store of value. So that's the analogy: 44, 71, and today. Those are the three epics of monetary standards.
All right, thanks for that intro, Mark, around the macro environment. So I want to shift gears now to talk about how the crypto ecosystem specifically is being impacted by the broader macro landscape. And as many people are aware, the Luna Terra collapse last month, obviously caused ripple effects throughout the space. And now, just over the past weekend, one of the largest lending platforms, Celsius, halted all withdrawals from their platform. And there's some concerns around the liquidity of that platform. And now we're starting to hear some other funds and platforms that may also be in jeopardy. So it seems like this is a broader liquidity crunch throughout the ecosystem. So Alex, maybe you can talk us through kind of what's happening with Celsius, what's happening in the broader ecosystem, and how that's impacting Bitcoin, Ether, and some of the larger crypto assets.
Yeah, absolutely. And it's a really interesting, not unprecedented and not unpredictable phase in kind of crypto land right now. So the whole DeFi and open lending construct is really about replacing kind of traditional financial metrics or traditional financial models, securities lending, liquidity provision, a lot of those things that are traditionally done by gigantic institutions within gigantic institutions and not really exposed to the light of day, and then replacing them with decentralized platforms like things like Compound and things like Uniswap, where a lot of those traditional financial operations are able to be done in a more transparent, more equitable, and more open way. And that's great in many, many ways, but there's sort of reasons and risk mechanics and things that have been evolved within the more traditional financial sector that aren't necessarily as prevalent in a novel version of a lot of those mechanics. So we really look at the DeFi sector and the open lending space as kind of the engine that powers a lot of the more traditional financial pieces that come across in the digital asset space. So when we're looking at where arbitrage trades get funded, where leverage gets taken, where all of these things happen, we're seeing it now is spread out across a large variety of different players. Some very transparent, some are novel companies that are being spun up using different strategies than what would have been in historical. Some are really, really institutional grade prime brokerages that are starting to do a different spin on what their traditional asset business was. And so what we've kind of seen in the evolution, and particularly over the last 18 months or 24 months, is really a series of trades driving the yield space in digital asset land. And it started out with the grayscale premium trade. We've kind of evolved into a series of basis trades that were able to take some arbitrage in between futures and spot prices. And all of those sequentially have kind of closed up or stopped being a functional trade. And we've seen the ripple effects of that through the market on a few different occasions. Now, what we're kind of seeing here as we get towards the end, where there isn't really a driving trade anymore, is people still looking for that yield, people still offering those elevated yields. And we're starting to see less real economic value and more of this leverage taking, more of these more esoteric arbitrage trades, more of the yield farming, and just more things that are even less tested than we've kind of been used to. And so what we're seeing now with, particularly with the collapse of UST and Luna, is this kind of ripple effect where what started out as kind of an A+ premium, well-regulated, well-understood arbitrage trade, and evolved using regulated assets and using regulated exchanges in a lot of the sense, has really evolved into a lot more riskier bets and a lot more riskier business models. Yet people are still offering the same yields, are still trying to offer kind of the same the same product offering out to the broader market. So when we look at the back end and the downside of that, then of course you're starting to see some of these models fail, and of course you're starting to see liquidity dry up and crunch, and it works until it works. So the fundamentals of the yield space and the fundamentals of DeFi haven't changed at all. We're just looking at different trades and different things that are driving those fundamentals now. So obviously, a lot of this is an industry that is driven by confidence in the space, and that's how traditional finance works as well. And so when there are these events and there are these major liquidity pieces, and there are big models that have driven a lot of capital into them, like the UST and Terra model, and those they rise extremely quickly because DeFi works at machine speed. It's extremely transparent. There is no artificial breaks in it, and it falls just as quickly. And so we've seen this. It's a really interesting case study, and unfortunately, think about it in kind of academic terms, in terms of contagion, and you can draw some parallels to the aftermath of Lehman Brothers and the aftermath of the crisis in 2008. And we're way too early to really accurately draw those, but looking at sort of the contagion that's rolling through the space right now, it's really about who had the proper risk management practices, who has proper asset liability matching, what strategies were all of these employers, lenders deploying. If this is decentralized finance, you can really have a algorithmic understanding of the book, who's involved, what the strategies are. If this is centralized finance, it's a lot more opaque. So you need to be relying on kind of on-chain data, on-chain analytics, and what you can kind of glean. So it's a really, really interesting, fascinating time of who really did it right, who took advantage of the right trades, who really built kind of solid economic fundamental businesses, and who is playing hot money and where that hot money is dried up.
Yeah, no, that's really good color. And so I guess when we think about, how Celsius and some of the other players in the market are positioned, when you talk about contagion, are a lot of these lending platforms lending to each other? I know there's been a lot of data that's been tracked on chain, to your point, of some of these lending platforms, how much collateral they have in different wallets, what their obligations are to their investors. And it seems like the probabilities of failure on some of these different networks or these different platforms is, changing by the minute. So when we think about that contagion factor, with someone like Celsius, is it more contained CeFi to CeFi platform, or because Celsius was a big operator within the DeFi ecosystem, is there risk to other DeFi protocols in the case that they can't meet their obligations?
Yeah, so I think it's a fascinating question in analysis, and I think we're well positioned to undertake it in blockchain world in a far better way than we were in traditional world, because every transaction that's ever been done by anybody on any blockchain is freely available for you, if you're able to kind of harness the power of that Batman machine and look into it. And the answer is, of course, there's contagion risk that this goes across. I mean, this is a nascent space where everybody is kind of oriented around similar trades and oriented around similar types of operating models. But there's real diversification in this space as well, and you can see it through the retail platforms of who they lend to, who they actually deploy assets to, and even as basically as, if I'm a platform taking in assets, am I lending those assets out to varying credit qualities of counterparties with varying collateral ratios? Am I lending them out only to certain people in over-collateralized world? Or am I deploying them directly into strategies, into arbitrage trades? And those, we kind of lump all of these platforms together, but there's various different flavors and different spins between those. And so when you look at kind of the top layer retail and then the second layer underlying institutional players, there's a lot of diversification of strategy within those assets or within those aspects. There's also a lot of Bitcoin miner financing that's floating around in there. There's a lot of liquidity provision financing that's floating around in there as well. So there's a lot of different pieces to these books. And so when one trade kind of goes away or when one trade happens, then it doesn't necessarily mean kind of the end of the book for everybody. So there's definitely, I mean, this is not the traditional financial system where we have hundreds and hundreds of billions of capital and also counterparties that are floating around. But it's also not the financial system in the good sense of that word as well. There's infinite permutations and combinations of what you can build in DeFi, where you can deploy capital, where all of this stuff comes out and shakes out. And so there's definitely contagion risk, but there is real diversification within the space as well.
Awesome. So now why don't we focus on how this all ties together? So looking forward, 6 months, Mark, maybe you can talk about what we see on the horizon for the macro space. Does the Fed do an about face on tightening? How do we kind of get out of the current situation that you described earlier that we're in? And then we can maybe kick around how crypto fits into that picture.
All right, thanks. We talked about the debasement or the money supply increasing that caused some asset inflation, and you obviously have other macro issues in Europe with the Russia-Ukraine situation driving supply chain issues and the China lockdown. Inflation is a big deal. It's not just CPI. PPI is 16+%. So there's an 800 basis point sort of frontier that companies may have to pass on to consumers. So inflation is job one. If that does not get abated with this rate hike, and that's why equities are up today, because people think the Fed's going to go after it and take the pain quickly. So they're hoping to get a quick fix, Chris. This is month by month. This is following the inflation prints, because as I said at the top of the day, the price of money doesn't matter. The Fed hiking 100 basis points doesn't matter that much, because the market already pushed the 2-year up 300 basis points this year. So we already have a flat curve. That should slow things down on the mortgage financing side, et cetera. It's the supply of money. So I think that inflation has to come in, and the Fed will continue to tighten by pushing securities back onto banks that don't want to finance them. So rates will continue to back up when that happens. Mortgages will back up. So if you see inflation stay where it is, you're going to see more volatility in the marketplace. So in a nutshell, we've never had a Fed tighten when they're already start to tighten when we're facing a recession and we already have high debt to GDP. And rates already at rising by 300 basis points. Very unique situation. This is again week by week, month by month, until inflation gets taken care of.
And then how does crypto fit into that broader picture, Alex? Maybe you can talk through, in an environment like that with a lot of uncertainty, a lot of macro pressure. Obviously, crypto has been lumped in with all other risk assets. It's sold off. It actually was holding up relatively well leading into this past weekend relative to like tech stocks. But now with some of the idiosyncratic risks that have been exposed within the crypto space, with some of the issues that we talked about, crypto has obviously sold off substantially. How do we go forward from here? How does crypto weather this storm?
Yeah, so two kind of key ways to answer it. And one, I'll talk about Bitcoin and sort of long only assets as a class, and then on sort of the leverage and yield markets as well. So first, we've had a really interesting phenomenon that kind of dates all the way back to the Grayscale product that was launched, or the Grayscale Trust, back in 2016. Once that happened and people started holding assets in regulated, more traditional types of entities, we started to see the uncorrelated asset thesis really start to diverge a little bit. And we've seen it, that whole story really take off as there's been more institutional adoption and more. Where we're kind of at now is that the historical kind of ethos-driven value proposition for Bitcoin is as an inflation hedge, as kind of a hedge on the entire financial economy, as that sort of take it, put it in your backyard, bury it in the vault type thesis, versus a lot of people have basically started pricing it as a tech stock. And we don't have a universally aligned fundamental value thesis for Bitcoin right now. Or digital assets in general. We're trying on a bunch of different hats. We've gone through the PQ equals MV craze and all of that fun stuff. But we don't have, in traditional valuation, we have the models that we use. People might haggle over whether it's this discount rate or that, but we're generally aligned on what we're using to calculate. And we don't really have that in Bitcoin. So it's a very narrative driven type of pricing right now. So I think we'll kind of see two things. One, as we get to kind of these market bottoms, or as we start to really see pain in the traditional economy, we'll start to see that tech volatility and that tech stock piece kind of pick up and then potentially fall away as there's more of a return to this inflation hedge and more of a return from kind of the original base of digital asset, or the original base of thesis, really pick back up as well. So I think it's always fascinating in the market to watch kind of which narrative is dominating the price of Bitcoin as we kind of go forward. And especially as macro trends evolve and kind of the real world really evolves, it's going to be really interesting to see how the Bitcoin narrative shapes going forward on that side. And then on the yield piece, there's kind of two ways that this could evolve. One is we find a new arbitrage trade, and there's a few interesting nascent ones that are out there, and that becomes kind of the driving trade. And we go back to something that's more akin to 12 months or 18 months ago. Or more likely, I think, is we've kind of watched the pendulum swing from a lot of really experimental models that are 2, 3, 5 years ahead of their time, or a significant kind of sandbox that maybe isn't ready for commercialization today. And I think we'll start to see that pendulum come all the way back to regulated digital assets, bank-driven finance, heavily kind of regulated in today's value proposition adjacent types of models. And we'll start to see a lot more supply chain finance. We'll start to see a lot more equipment-based finance. We'll start to see carbon credit finance and things there where blockchain can be used in the actual business model to create better net new returns. We'll start to see a lot of finance and yield generated by those that are different, better in different ways, but more comparable to kind of traditional lending and traditional finance. And I think all of the mechanics that we've built over the last 2 years are phenomenal. The amount of infrastructure that's been built up in the DeFi space and by the centralized counterparties is amazing. We've been using it for kind of weird reasons a little bit. So I think we'll start to see all of that infrastructure used for a lot more traditional types of commerce. And that's all of that together is kind of the next evolution and unlocking of crypto. And that's always how these market cycles work. And I'll kind of wrap it up on this is you have a lot of interest and a lot of inflow, a lot of weird things get funded. We see this massive run up and everything. And then the hype kind of goes away. And all of those ideas and all of those things that got 85% built because everybody was kind of running around chasing the hype, those are all the things that get finished in these down markets. And then the next wave really takes advantage of kind of this exponential stacking of infrastructure. And so there's so much really interesting, really novel, really talented stuff that's been built in the last little while that I'm super excited to watch all of that complete. And work with the finances, work with the existing financial institutions, work with the regulators, and kind of create this next generation of digital assets.
Yeah, and I think we saw that same evolution from the last cycle, right? The 2017 excitement and bull market, and then moving into 2018, 2019, when we moved into a crypto bear market. But there was a ton of great development, a lot of the layer one protocols that really were star performers in 2020, 21, 22, and the emergence of DeFi. A lot of those protocols were built and launched during that crypto winter, right? Compound and many other large platforms were really launched at that time. So similar, unfortunately, the cycles in crypto can be very volatile because there's this exuberance. There is less regulatory oversight. So there's this kind of free range to innovate, which is super exciting. And you get these amazing products and amazing use cases. But then at the same time, the over exuberance can lead to more severe upswings, but also more severe downswings. But that's why I think a lot of investors look at it as a really attractive asset class from an asymmetric standpoint. And so, Mark, I want to ask you then, taking into account the broader macro environment and kind of what Alex just mentioned, are we looking at another 1.5 year crypto bear market like we saw in 2018, 2019? Are we looking at more of a March 2020 bounce, V-buyer? Because it sounds like many economists think that we could be going into a broader cycle in the macro environment of relatively low growth.
Yeah, low growth is the home run for crypto. And it's the reason why I think you had that March 9th executive order by Biden, and then the about face by Janet Yellen a few weeks later in April at an address she gave in the US. Technology is disinflationary to deflationary. It provides more for less. That's why Amazon is taking over the storefronts in retail. People may not like it, but in a low growth environment, people are choosing to get things faster or cheaper. And Bitcoin provides that. So Bitcoin provides it, the protocols on Ethereum. Alex goes over some of his yield products and how they're more efficient. So this is not new, and the government's recognized it. We are in a growth compromise environment with the level of debt we have, with the aging population and the entitlements. That will lead to a lower growth because there's less cash for investment. And technology is the alternative that you have to add to each industry. It's done in the automobile industry. It's being done in the utility industry. Obviously, finance likes to hold on to traditions because that's what we do, but it's coming and it's here. So I think somewhere between, 3 to 9 months is when you're going to get regulatory clarity. And, there's one point that people forget. We already have regulatory clarity. Bitcoin has been deemed an asset by the IRS. So there's clarity on how to own it and custody it and put it on your taxes. So that was a big deal, which I think some people forget. And it's only been followed up, as I said earlier, with the executive order.
Yeah, I also think that just generally like deflationary assets like gold, like Bitcoin, in an environment like this, where we're obviously paying for excessive monetary expansion over the last 10 plus years, can be a really attractive asset from an allocation standpoint. And so, bear markets like this, although there's obviously a big crunch in liquidity, prices are extremely volatile, it creates really attractive potential entry points into the ecosystem. And what we've seen, there are really large institutions that have raised substantial amounts of capital. A16Z just raised several billions of dollars to deploy into the venture space within the crypto ecosystem. And there are several other large institutional entities that are doing the same. So I think you're going to continue to see investment within this ecosystem. But I would say one thing that's an interesting observation from just talking to a lot of investors over the last several weeks and over the last several months it's been a fascinating trend where a lot of institutional investors that have entered this ecosystem, Alex, you mentioned this before, as more and more people have allocated, correlation, it's become less of a niche asset and a little more mainstream. But I found that the way that a lot of investors are allocating are actually directly to venture funds. So institutional allocators, there's a few reasons why. One, a venture strategy kind of fits in their already existing asset allocation framework, right? They already have venture strategies, they already have an alternatives portfolio, and they could slot in a crypto-specific venture strategy into that. But two is also, to protect themselves. They're looking for a manager that they can reduce any type of career risk by having a manager that's overlooking that portfolio. But the interesting result of this is a lot of these venture funds hold a combination of venture capital, equity venture capital, so equity ownership in companies like Celsius or like crypto exchanges, asset managers, mining companies, and then a combination of that alongside like token deals, which are early stage protocols, projects that are hopefully the next wave of innovation in space. But I guess the observation I want to make here is I think it's really interesting that many investors have kind of skipped over the larger, as we would probably refer to them as blue chip protocols like Bitcoin and Ether, because of the career risk and because of the structure that venture funds provide as a convenient vehicle for allocators. And so I think one takeaway from the entirety of the latest situation with Luna and with Celsius and with some of the other fund managers that have been struggling in environments like this, I think it's good to reset and realize that Bitcoin and Ether, the protocols themselves, a ton of the value of this ecosystem accrues to those protocols, right? So if Celsius is successful, or if Coinbase is successful, or if another large player is successful, value is also accruing to the actual protocol level. And so I do think Bitcoin and Ether shouldn't be glossed over when thinking about a really thoughtful way to allocate to this asset class. That said, that's not to say that venture isn't appropriate. It's just really taking a holistic view. You have kind of Bitcoin and Ether, the protocols, blue chip protocols. You have a venture, you have yield, like we've talked about, a really thoughtful way to deploy yield. I think it's important for investors to understand how broad this asset class is and being thoughtful about how to deploy across that. So with that, I'm happy to open it up to questions here in the audience to dive in deeper on any of the topics that we've touched on. With the closing of today's webinar, we will send out an invite to everyone that joined to provide some additional market commentary. And of course, feel free to reach out directly to 3iQ, and we're happy to connect directly and answer any other questions in more depth. Thank you to Alex and Mark for all the great insights.
Great, thanks, Chris.
Thanks, everybody.
Okay, so looks like we have a few questions in the chat already. So I'm just going to go in order of what came in. First from Alexandra, agree with your point regarding Bitcoin becoming an alternative store of value and comparing it to the 1940s and how gold gained significant value over that decade. However, as of now, Bitcoin is trading as a tech stock on steroids. So what would be the trigger to force a decoupling? So I think one thing, just to kick it off, and then I'd like to get Mark's thoughts. I think talking about the environment that we're going into right now, I think everyone's very focused on the Fed's raising rates. Mark talked about like the demand destruction that's kind of happening right now. Risk assets are dropping in value. This is all in the effort of reducing consumer spending, essentially, to try and help tamper down on inflation. But the reality that Mark highlighted is that we have longer term issues that can't be solved by raising rates. Things like deglobalization. We have an energy crisis just more generally. There's all these supply chain issues. And so in an environment like that, where we're likely to have kind of persistent inflation over a longer period of time, even with the efforts of the Fed raising rates, they can only go so far because they're going to have trouble servicing their debt. Debt to GDP ratios are at very high elevated levels. And so in an environment like that, where you have kind of persistent inflation, right? Bitcoin stands apart from tech stocks in that it is an asset with limited supply. It's a scarce resource, similar to something like gold. And so in an environment like that, I think that Bitcoin is going to outperform. Mark, what are your thoughts there?
Want to make sure you guys can hear me here as I'm piping in. Is that good? Perfect. Yeah, Chris, your point about the difference between tech stocks, I guess there are three things. Firstly, Bitcoin didn't borrow debt in order to buy back their stock to increase earnings per share. So you saw tech companies do that with their excess cash flows. So they benefited from a low rate environment. As rates go higher, Bitcoin will keep printing 210,000 blocks every 4 years. Their plans on that won't change. However, the earnings profile of tech stocks will. So I think that'll take time to bear out, a couple earnings cycles. That's one. The other one, which is a shorter term, is just weak hands. People who use leverage positions, people who had arbitrage positions, as Alex mentioned, whether it be, in the old days, a Grayscale Trust, maybe people are still in that trade. So you'll see some ebbs and flows, but some declining correlation as that trade unwinds, because leverage is leaving the system across all assets. So that's the second point. And then the third point is just flat out demand destruction that we talked about. As that decreases, people are going to be looking for some store of value as bonds rates go higher, prices drop, equities become marginalized. Cash will go to the strongest network. Between 2008 and 2000, today, housing prices globally caught the bid. That's where the store of value went. But again, rates were low. As rates go up, that may be challenged. So where would you go? We think Bitcoin, as that store of value, is a clear choice and has the primacy among the investor community. So that's how to answer that.
Great. The second question comes from Anonymous. Bitcoin price has crashed more than 70%, and Ether is also down significantly as interest rates have gone up. What is the short-term future in light of a couple of increases in the Fed rate happening? So I think there's a few different indicators. One we can look at, we talked about some of the idiosyncratic risks that are coming to the forefront within the crypto ecosystem, like the liquidity crunch that's caused the collapse of UST and Luna, and also what's causing issues with the Celsius platform. There's a couple other things that we look at though in the short term, and one that is an interesting indicator that has generally indicated when we're getting closer to the bottoms is miner capitulation. So the crypto ecosystem has a few systematic actors that put sell pressure onto the market. So crypto exchanges are one of those. As their trading activity picks up, exchanges have to sell crypto to fund their operations. Miners are another huge one. Miners hold a huge amount of Bitcoin, and generally in cycles where the market's growing, they hold on to that Bitcoin, and in markets where the price of Bitcoin is contracting, the miners are forced to sell. They have to pay for their energy costs. They have to pay for their operations. Many of them are going out of business because they don't have the same profitability they had when Bitcoin was at 60 to 70,000 in US dollar terms. And so we're starting to see some of that miner capitulation. There's some good statistics around miners and how much they're selling, and that selling process has begun here. So we could be coming closer to a bottom, which again means that we're flushing out of the system a lot of the leverage, a lot of the long-term holders like the miners, and that gives us the ability for kind of price discovery and reinvestment to begin, especially in an environment that we talked about that may be, an inflationary one that persists for some time. Mark, any thoughts there?
I love that last point about price discovery, Chris, because in times of uncertainty, people just bring everything home. So that includes any levered player in the crypto space. And when we find a normalized level, so again, I think that's 3 to 9 months out. We like to look at the producer price index, which is at 16.7 in the US, and not just look at CPI, which is at, I think, 8.6 it printed last week. Because if it maintains that basis, which is an all-time high, that's the widest basis on record going back to the early 60s, where our data stops. And we think that if it maintains that, companies will pass that along to consumers. So you'll see inflation continue until that abates. And Chris, that goes back to the point you brought up earlier about the Fed. They don't control this. This is, producers are getting hit because of supply chain issues. Raising rates doesn't address that. So we're in quite a conundrum. And back to that point about price discovery, when PPI collapses to CPI, when we see that normalize, the rate regime stops. That's when we have reinvestments start. And it's going to be an area where the Fed, I think the money supply will not be that far different where it is now, and the spigot will go back on. So I think that's the steps. PPI, CPI collapse, rates slow down, and the spigot goes back on, because that's how the government has to fund itself.
And Bitcoin outperforms in an environment like that.
And Bitcoin, absolutely.
Yeah. And so I think that actually answers another question that we had from Mark Herbert in terms of what do you see as the next catalyst for Bitcoin and Ether? I think you just described that perfectly. Another question from Tara. Many believe the CPI numbers have been understated for the last decade. Have we been in a higher inflationary environment since the global financial crisis? What are your thoughts on this? Mark, maybe you want to take that one?
I'll touch on it. I think you were off screen. We were talking earlier, and you had some good points as well. Yeah, I mean, our first publication, I joined the firm just 3 months ago, was called The Monetary Ratchet. And, we showed that between 1981 and 2008, the money supply, the Wilshire 5,000 market cap, and GDP all grew ratably about 5-6%. There was a balance in the system. And not surprisingly, the Fed balance sheet was less than $1 trillion and not growing that much year over year. That changed with the global financial crisis, when you had a contagion, a true contagion. Here we have it washing out, different. So since then, you saw a shift, you saw an imbalance where the money supply grew about 8% a year between 2008 and today. Equities grew about 6% and GDP just 3.5%. The reaction to COVID blew that apart. Money supply, 2 consecutive years of 18% growth. So I guess to answer the question is, yes, there was inflation. The reaction to the GFC put excess money in the system. Velocity went down, which means it wasn't caught up in investment and the real economy. It went right to financial assets. So the fact that the government uses owner equivalent rent, which is a voluntary submission instead of housing prices, that would change CPI dramatically, because I think it's like 1/3 of the CPI. So yeah, whoever asked that question, Tara, spot on. And now you're seeing things they can't hide or change, like energy and food.
Great. I think the last one is, hey, it comes out that 3 Arrows Capital, one of the largest fund managers in crypto, is having a liquidity issue as well. How might this impact the space? So I think this comes back to the conversation we were having earlier around contagion. And unfortunately, for 3 Arrows and for many fund managers in the space, there have been a series of events that have happened over the last year that are impacting this situation. So first and foremost, the grayscale arbitrage trade, or for that matter, all closed-end funds that provided exposure to crypto. Before there are ETFs, which of course there are still not ETFs available in the US, but before that happens, the vehicles that have been most easy to access crypto, at least in the States, were these closed-end trusts that were traded over the counter. Grayscale and several others had these vehicles. Those traded at a premium historically, when ETFs in Canada and in other jurisdictions started to become popular, and it was easier to access Bitcoin and crypto tracking products that weren't close-ended but tracked the price better, a lot of those products started trading at a discount. And so a lot of fund managers, a lot of hedge fund money was in those products, essentially acting as a market maker to try and get the price closer to NAV, but they were taking advantage of the premium that was in that product. And so Three Arrows is one of those funds that was a huge player in that trade. Again, when the premium disappeared and went to a discount because now there were ETFs available in certain jurisdictions, Three Arrows got caught up in that trade. So they lost a substantial amount of assets, and they were levered in that trade. And then in addition, when you start to have, that was, a year ago that happened. It didn't have, big impacts until just recently. But then when you add on the UST collapse, and funds like Three Arrows may have, levered exposure to that ecosystem, now you're starting to get into an asset liability mismatch where assets that they thought were liquid current assets are now illiquid and underwater. And then the value of the collateral that they hold, like Bitcoin and Ether, has now gone down 50, 60, 70%. So now they can't service their outstanding debt. And so they've fallen into an insolvency issue. How that winds up is to be determined. And hopefully, we don't see other high profile funds get into this situation as well. But as Mark always says, like in environments like this, things start to break, and things are breaking right now. And until all of that breaking is done and there's full capitulation, like with the miners I talked about earlier, all of that needs to flush out before we can start to work our way back higher. Okay. Well, thank you everyone for joining. Really appreciate your time. Feel free to reach out. I think Tara and the team is going to send out a recording of the session later today. And please feel free to reach out directly to Mark. Lauren, I don't know if we have our research team's contact information that we can make sure that we share with everyone. But Mark and myself and others on the team will make ourselves available if anyone wants to have a one-on-one meeting or dive into this further. Thank you, everyone. Thanks, Mark.
Take care, guys.